Hello and welcome to another video everyone. So in this video, you will learn what a trending market is, the types of trends, how to determine a trend, and I'll share with you a very simple yet highly effective strategy that will improve your trading skills. All that and more coming right up, so stay tuned. What is a trending market? A trending market is one in which price moves in one direction, either up or down. So a upward movement is called a bullish market, and a downward market is called a bearish market. That's pretty simple. But you must have seen the market doesn't move always in one direction like this, right? The market doesn't always go in one direction or move the other way in downward direction like that. There's always what we call as a pullbacks, okay? And that looks like something like this. So a pullback is a small retracement towards the downside, and then the market continues towards the upside again, and there's another pullback, and it keeps moving like that on an uptrend, okay? And vice versa on a downtrend. So the market goes down, there is a pullback, market goes back again, back down again, there's another pullback, and it continues to go down. That's a normal scenario of a market, right? Now, the longer move, which is this move, this is called as an impulse. You can call as an impulse. So I'm going to point that. So this is called an impulse, or you can also call as a leg. So a leg or an impulse is the longer part of the wave of the trend. And the shorter one, which is here, this one, can be called as a pullback or a retracement. Okay, same thing on a downtrend as well. So far, I hope it's clear. So when a market is moving upward, right, when we have this uptrend, the market forms something called as a higher high and a higher low. Why we say it's a higher high? This is a higher high. Okay, these points are higher highs. And why are they higher highs? Because on an uptrend, when the market is going higher and higher, these are forming new highs. And when the market is trending down, so it's the opposite. So we have the lower highs, these are the lower highs, and these are the lower lows. Okay, I'm just going to call this as LH. LH is lower highs. Let's go on our charts and see these in live examples. Now, just to remind you, this video is going to be a bit long, but you're going to learn a lot of things. So please pay attention, and if you haven't subscribed to my channel yet, hit the subscribe button and let's continue. Okay, so here we have a chart of Euro USD on a daily time frame. Now, daily time frame means that each candlestick represents 1 day of trading. Now, as you can see, it's pretty clear the market is downtrending. The market is downtrending because we are able to see clearly on a downtrend. What we need a lower highs and lower lows, right? So we have these lower highs, and we also have these lower lows. So 1, 2, 3, right? So we have lower highs and lower lows. Now there are two ways of trading a trending market. You can trade the trend or follow the trend. So you can do sells on a downtrend, or another way you can do is you can buy the reversals or the retracements. Now buying the retracements is a bit more complicated, so we'll leave that for the next video. But for now, let's look at how do we follow the trend. The first things what you need to do is you need to connect all the lower highs on a downtrending market. Okay, so when you have connected as much as you can, now the thing is you won't be able to connect all of the lower highs. The reason being is that the market doesn't always follow that beautiful slope pattern. The market tends to, as you can see, the market when it did this impulse, the retracement didn't go and reach all the way on that line, the market reversed early. But here it does, and here it does as well, almost, and here it does too. But here the market didn't, and that is fine because that's how the market is. The market will not follow a particular rule or a law. Okay, so once you have connected the lower highs, as many as you can, the next thing you're going to do is you're going to draw lines from the swing lows. Now, the reason why you're drawing these lines is because these are the points, or these are the levels where the market has had reversed or retraced, right? Here, look at the retracement. And again, here, the market retraced. Okay, that's the significance of those levels. So what's our goal? Our goal is to actually do sells on the impulses, right? So that's what we're trying to do. Now, a high probability setup. Now, this setup is not complete because you need a lot of confirmations. So what I'm gonna tell you is pretty basic, and it's almost like we're just scratching the surface. We can build more and more on that in the next videos. But in this video, I'm just gonna show you the most simplest way to recognize a high probability setup, which will give you more opportunities to make profits. So now we want to be trading Euro USD sell. Okay, we have confirmed that the market is downtrending. We are seeing these impulse, and we saw a pullback, and we've drawn our lines on our support levels. And we have seen previously over here, right at this point, the market tested that trend line. Okay, in fact, actually, here the market created this new trend line. This new trend line didn't exist before, right? It used to be, it was probably here. It would have been something like this, right? Now, since we have this new point, we're going to follow that, and we're going to draw a trend line all the way to the down. Now we want to be doing a sell over here, right? This is the point where we want to be trading, and we are seeing the market trending down at the moment, and all we're doing now is waiting for a retracement. And the market has retraced. The market has, let's say, reached at this point, right? So the market has reached our trend line, has touched our trend line, and the market is actually pulling back. It's rejecting that trend line. So this is a high confirmation, is because not just it was a previous support now turned resistance. We have a trend line which the market is rejecting, and the market is downtrending, so we are following the downtrend. Okay, but the market, but there's it's not as easy as just doing a sell when the market reaches that level. There's a lot of conflict as well happening. Okay, that's pretty clear. So when the market reaches that trend line area, we're not going to be doing a sell right away. We want to see what price action plays out in that area, right? Either it's going to be either a break, right? Either that, or the market is going to continue to go down. Okay, there's a third scenario where the market can start ranging, and that's what happened over here, right? We had a bit of a range, and then the market eventually came down, but for a little while, in fact for about 3 or 4 days, we had a bit of a range. There was a lot of conflict between buyers and sellers at this point. Okay, so let's take an example of USD JPY. This is a daily chart. Now again, you can see the market is clearly downtrending. Let's take, for example, we want to be trading at this level, like from here. Yeah, so we have no idea of what happened in the market in that blue zone. We only have knowledge until here, that green candlestick that you can see over here, right? Okay, so it's clear that the market is downtrending. I'm gonna draw my trend line. How am I gonna draw my trend line is I want to draw like that, right? Why am I drawing this trend line? Because I'm trying to connect the lower high. This is a lower high, right? Although it's not very significant, but it's still a lower high. But look what happens over here. I'm gonna take the highlighted area a little bit. So when the market comes back and retest on the retracement, the market didn't retrace right away from this point. It didn't do that. It went higher than that. But the market didn't actually break the structure. The market breaks the structure when it breaks the previous low, right? If the market created a candlestick like that, sorry, it's a bad looking candlestick, but if that was a candlestick and the market continued to go down or go up like that, then that is considered as a trend reversal. But that didn't happen. Okay, um, the market actually shifted. It moved this way, and the market can tend to do that. So it could go even that way. Like it can start ranging for a long time, keep going up, but retest previous support, which is now resistance, and continue to go down. By the way, if you haven't watched my video on support resistances, a beginner's guide to support resistances, I'm going to link the video in the description below, so be sure to check it out. Okay, I hope this concept is clear for you. Now, let's go back to trading our USD JPY. Now I'm able to see the market doing a retracement. Okay, the market is doing a retracement. Of course, it's gone above my trend line, but that's fine because now I understand that breaking a trend line doesn't mean the market has broken the structure. The structure is broken only when the previous swing low is broken. That didn't happen yet. Okay. Remember, this video is to explain a strategy that has a very high probability setup. Now, this you can also say is a high probability, but it's not exactly confirming two things. One is the market has gone slightly above our trend line because our trend line initially looked different, right? Our trend line initially looked like this. Um, but in the case of Euro USD, remember we have all the boxes ticked. So we have the trend line maintained. The market was in the previous swing low, right? The market is holding that previous swing low. But the only thing is, of course, the market has gone above that area, but we are not sure of what's going to happen, of how we're going to trade this. And this is when patience come into the picture. So now I'm looking at Euro USD on a daily time frame. Now on the daily time frame, it's pretty clear to me of how the market is looking like. Now if you want to make an entry, I have to go down to a smaller time frame. The reason why I do that is because I want to enter into the market early. If I enter on a daily chart, I'm going to be taking a lot of time and I may not find entry point. So if I go down to let's say an hour or a 4 hour chart, it's easier for me to confirm my entry level. Now another thing you have to understand is if there is a conflict of trends. For example, if your downtrend, if your daily time frame says that the market is downtrending, but on a 4 hour chart the market is saying it's uptrending, you cannot still do a sell right away. You have to wait for the market to change from the short term bullish to a short term bearish. So if you have clear direction on all time frames, now I'm not saying all, like you have to look at every time frame. I'm saying at least a daily chart, daily time frame, 4 hour and 1 hour. So if these three time frames are giving you the same direction that the market is going to head down, that's when you want to be entering. Okay, that makes it a very high confluence. Now this high confluence strategy that you can call is purely based on price action. I haven't added any indicators at all. Usually when we do a trade such as this, we also want to confirm with a couple of other indicators. But remember, indicators only tell you what happened in the past. They will not tell you what's going to happen in the future. Price action gives you more clarity. But indicators, of course, help you to give you the direction of the market, to give you additional support resistance levels or retracement levels. So let's go down on the 4 hour time frame. Now, on the 4 hour time frame, going back. So this was our trading scenario. So the market retraced. Now look how it looks totally different. The market doesn't look the same on the 4 hour. It looks a bit more noisy, it's a bit more complicated in the sense that there's a lot more going on, right? Okay, so once the market has retraced, our our rule was not to enter as soon as the market reaches. All right. Now we have this big candlestick over here, which is probably related to the news. This was just a random spike in the market, which we're not going to take into account that much because there's a lot more else happening, which is this, right? So, and that. Okay. So the market seems to be heading up by the looks of it. It's testing and retesting, of course, because it's testing the trend line. And then what happens is the market starts coming down heavily, but starts going back up again. So where do we enter? Okay. Um, let's look into that. So so I said a while ago that the mark when the market reaches that trend line and your high confluence area, which is supported by that previous support, which is now resistance, the lower low, um, we said not going to enter right away. We want to see more further confirmation. What is that confirmation? That confirmation is that confirmation is a break below your previous support, a break below the support level on a smaller time frame. In this case, the 4-hour time frame. So the market, first of all, creates this support level over here the first time. Okay, goes up, creates another one over here. Now, although it's a bit lower than that, but it's almost in the same range. Now, remember, support levels are not specific lines. They can have a range, right? And the market retested that support one more time, went back up, came down, and then we saw clearly this break below the trend line. This is our this is our almost like confirmation, right? So if we did a sell here once that candle closed and kept a stop loss of, let's say, above the trend line, the previous resistance, maybe somewhere around here, if this was our stop loss, okay. So one thing is confirmed is that the market is turning bearish from a ranging market. And this happens a lot, guys. When the market is making a big move in the market doesn't easily go break and just go down. It starts to range and then make a move. And that's what exactly happened in this case. Now let's compare that with USD JPY. On USD JPY, it was a different story altogether. It was very, very clear, very easy. Right? If I had to do a sell over here on a retracement, so when the market was retracing, there was an uptrend, right? This was a small uptrend, of course, because the market is retracing. Now we need the market to follow the same direction on multiple time frames. In this case, the 4-hour. The market needs to confirm the direction on multiple time frames. On the daily, it's confirmed the market is going down, but on the 4-hour, it seems like the market is going up. Although this was a high confluence area, the market retested. So let's go down to our 4-hour chart. So market trending up and up and up. In fact, we have another trend line over here. So this is another mini uptrend on a smaller time frame such as 4-hour. Our natural bias, our natural direction is a downtrend. Okay, but on the 4-hour, we have a small uptrend. Now to confirm our entry, what do we need to do? We need to make sure that this small uptrend is changed into a downtrend. How does that happen? That happens when the market has broken the trend line. You know the market has broken a trend line when you have these big bearish candlesticks following in your direction. Right? When that happens, usually there is a general idea that the market is now going to go down. Okay. Now where would we do our entry? Our entry would be once this candle is broken, would probably enter around here. Now, of course, the market did a bit of a retracement because this was a support level from before. expect that to happen, but sometimes it doesn't happen at all. Sometimes it just keeps going down like that. Okay, so you want to enter once this candlestick has broken the trend line and you're doing a sell there. So your stop loss would be again above the previous resistance, and you have this pretty easy break. The next time the market retested, the market broke. Okay, I hope this is clear so far. Okay, so before I end this video, I'm going to show you another example. Now this is AUDUSD, and this actually happened just recently, and this trade is actually running for us. Okay, so now AUDUSD, you can see clearly the market is uptrending. Now I'm going to block this area, and we pretend that the market is exactly at this retracement level here. Okay, so I can do that by using the bar replay. So okay, so right now we are at a point where the market is retracing. Now first things first, as I can see, the market is uptrending, right? Now how do we define a trend? A trend is defined when we have the two impulses, which we do. We have one impulse, we have a pullback, we have another impulse, and we have a pullback. So this is a trending market already. So on an uptrend, remember we have higher highs. So a higher high, another higher high, right? Higher low, another higher low. Or we can call them swing highs, swing lows, swing high 1, swing high 2, swing high, swing low 1, and swing low 2, right? Hopefully it's clear so far. Now the next thing we're going to do is we're drawing a support level on our swing low. It makes sense because we want to be trading now. Okay, now if the market had come down but started reversing already, we are not interested in this trade anymore. There's another way to trade that, which we'll go into in the next video. But in this video, we're focusing on the high probability setup. Okay, which means that the market has to retest our swing low. That qualifies for our trade in this case. Okay, so the market tests the swing low, and another important thing you have to remember is that when the market is retracing down to our swing low, you have to wait for this day candle to close. Okay, you cannot be trading when the market is still moving, because you never know how that candle is going to turn out to be, right? So wait for this candle to close. Once it closes, then you can plan your trade. And how are we going to do that? So once this day candle has closed, we are now looking to do a buy and follow the uptrend, right? So I'm going to draw my trend line. It's pretty clear, right? This trend line is very, very clear and very easy. The price is holding that trend line after that day candle has closed, right? Now the next candle opens. We don't know where it's going to open. It can open anywhere. But what we're going to do is we have to figure out where we're going to enter and how we're going to do the entry. Now, I'm going to go to a smaller time frame, such as a 4-hour time frame. Now, on the 4-hour, this day candle actually closed slightly bullish. You saw that because there was small pullback. So it's already suggesting that the trend, that the levels for now it's holding. It could as well break the next day when it opens and start going down, but that's not what we're here for. We're here to see what happens after that candle is closed and the next day when the new candle opens. Now on the 4-hour chart, you're seeing this downtrend, right? You're seeing this downtrend because see what happens here. From here, the market starts to come down. That was a retracement, right? Don't be afraid of that, because the general trend is bullish, and we are going to stick to our strategy. The strategy what we have is that we are able to see a trend. We're able to draw a trend line. We noted that the market had tested our swing low, has tested our swing low, the previous swing low. Now the market opens. So as you can see, the market is kind of playing out on that trend line, but it's still holding that trend line. For as you can see, we're still not entered yet, right? Remember what we said. As soon as the market reaches that trend line, we're not going to enter. We're going to see how price action plays out, because there are three possibilities. One is the market can retest, go on a range like it did here, and then either break towards the upside, which is what we're looking to do. We want to follow the trend, right? It can also break this easily with a couple of big red candlesticks and start going down, or it can just clearly go up without ranging. The market can simply start shooting up with some big bullish candlesticks. Now we have this scenario where the market is starting to range, but look how the market is ranging. So the market is just above your trend line. It's not breaking above your trend. It's not breaking below your trend line, right? That's very, very important. Another thing you have to notice is the market is ranging. So when the market is ranging, you have your support and resistances. Okay. Now, these are resistances. And why these are resistances? Because we are seeing multiple we're seeing multiple rejections on that level, right? Which means that the market is telling us that it's trying to break, but it's not able to. But it's maintaining the trend line and it's failing to actually go below that trend line. If these candlesticks look like that, right, like that, and then like that, then we are not interested in doing buys at all. The whole thing changes then. Okay. The reason why this becomes a very high probability setup is because the market is maintaining that trend line. It is ranging and slowly heading up. Okay, the market will not keep ranging forever. It will either break up or down. So in this case, the market shot up. There's no like 100% system where the market will follow a particular strategy. There can be instances where even after this candlestick has formed, the next candlestick could start turning bearish and start going down. Okay, that happens as well. So trading is all about probabilities, and we need to stick to our strategy. So once that candle closes, the candle closed above, in fact broke through that level. The market is suggesting that it's forming this ascending pattern heading up, and this candle broke through that level. Our entry is going to be here. There are two ways to enter the market. One is you can either enter as soon as this candle has closed, right? So you're going to enter here, or you can wait for the price to come back down and retest on the trend line. But I I like to enter when the market has broken that level and the new candle has opened, because sometimes what tends to happen is the market will not come back and retest that trend line. It will start just shooting up, okay? And then you miss the trade. So the market did come down a little bit, but that's fine. Another thing why this trade is so effective is because it has very high risk to reward ratio. Now, what is a risk to reward ratio? You're risking a certain amount and you're earning a certain amount, right? In this case, if I keep my stop loss below the swing low, because remember, if the market starts breaking that trend line or starts breaking the swing low, sorry, and starts heading down, then the whole thing changes. It's no longer an uptrend anymore, right? But we anticipate the market to maintain the trend line and maintain the uptrend. So let's say we have a stop loss of 350, right? And our we are entering at around 650. So we are risking about 30 pips. So our take profit is over here. So which means we are risking about 35 pips, but towards the upside, we can potentially earn up to 70 pips. I hope this is clear. Let's do a quick recap. So what did we do first? We understood what a trend is. What is a trend? A trend is when the market creates higher highs or higher lows on an uptrend, and lower highs and lower low on a downtrend. Once that's confirmed, what we do is we plot our levels on our lower lows, which we did over here. So every time there was a which we did over here. So this was a swing low, and in fact we have another swing low here, right? Swing low, a swing low or a lower low, okay? And these are the impulses. So once we know the direction of the market, that the market is trending down on a high time frame. Now a high time frame can be daily or a weekly. The reason why we choose daily or weekly is because you have more clarity of the trend. We also understood that market doesn't always trend smoothly. It's kind of choppy. That's how the market is. Okay. And if the market breaks your trend line, we said that if the market is breaking your trend line and starts moving sideways, it doesn't mean the market has broken structure. The market is just ranging, trying to reach the previous swing low or lower low. The market is breaking structure only when there is a break above the previous low or the previous support, then there could be a trend change, right? Hope that's clear. So what we do then? So once we found the direction of the market, we had to wait for two things. One is the market to retrace. Like in this case, we waited for the market to retrace, go towards our trend line, and also rejecting the previous swing low. Once the market did that, we were trying to do a sell because we want to follow the natural direction of the market, which is down. Now, when you're doing a sell, you will not always have a scenario where the market is, retracing and then creating big red candlesticks and just going down like that. No, the classic example is right in front of us. You can see that on you can see that clearly on Euro USD on the daily chart. The market is creating these has created this range, right? It's moving sideways. That tends to happen a lot. Expect three things to happen. One, the market either starts ranging. Two, as we saw as USD JPY, when the market retests, so the market could start ranging, or the market can just break through the level, like in this case it did. Retracement, leg, again another retracement, and then this was a clear break. This was pretty clear. The market just shot through that level, just break through that level, and we saw just these red candlesticks heading down. Okay. Or another scenario is when the market can go up, test the previous swing low, also test our trend line. So test our trend line and test our previous swing low and break above the trend line and start doing that. That can happen as well. Multiple scenarios. As traders, what we do is we look to react with the market. We trade according to the situation. We do not try and put our theory or our prediction and imagine the market to behave that way. The market can do its own thing. All we do is we try to we try to make our move according to the situation of the market. Okay. So in this case, we saw the market moving sideways, which was pretty clear over here, which was a bit of a conflict. It was a bit of a complicated trade, and we had to get around it. And how did we get around it? We we go down on smaller time frames. Um, it doesn't matter if the market is ranging or clearly going down. We always go on our smaller time frames to find out the entry, right? So 1 hour and 4 hour time frames. So we clicked on the 4 hour time frame. On the 4 hour time frame, we saw this happening. We saw this big news effect. We saw the market reaching the trend line pretty clearly, but there was also a rejection. But the rejection wasn't very clear because in here what happens is that the market started to range, right? When the market started to range, it started creating these support levels. Support level 1, support level 2. Okay? And these are 4 hour, this is a 4 hour time frame, so it's still pretty strong. It's not like a weak support or whatever. It's still an important support. So we draw our line on the support level, and to be safe, to be able to have a very high probability setup, what we do is that we wait for the market to break below that support if it retests one more time. If it doesn't retest, the possibility are the market can keep heading up. But in our case, the market did retest the support. So our job was to simply enter when we see the market breaking, and which we did see over here. The market broke through that level with a huge volume, and as soon as that candle closed, we would do a sell over here. That would be our stop loss, and the market continued to go down, right? I'm planning to start doing webinars again. I used to do a lot of them in the past. We had everyday webinars similar to that. I know in hindsight things look easy, but when you're actually executing the trade, when you're trading live, there is a lot of uncertainty involved in traders. So my goal is to actually do a step-by-step sort of a training in the webinars where you're watching the trades with me, and we are analyzing the markets together. There are no secrets in trading, guys. If anyone tells you there's a secret trading strategy somewhere hidden that only they know about, they are not correct. Everything is available. In fact, if you keep your eyes open, it's all available on the charts. The market is always telling you something, right? This was a very simple strategy with just purely based on price action. So this is all I have in this video for you guys. I know this was a long video, but thank you for watching. If you did like my content, please give me a thumbs up and do share your feedback in the comments below. I look forward to hearing from you all, and also subscribe to my channel, please. As usual, have a great trading week. Thank you. Bye.